Okay, I welcome you all back to class. For this period, we would wrap up on statement of financial position, consolidation, using the principle of cancellation. In the first period for today, we started by revising or concluding IS 36 on impairment by solving the two solutions on the assignment I gave you. Then we started up on group account. We have covered quite a lot on group account. We analyzed why we are preparing group account, which is intercorporate investment. Then we narrow down to investment in subsidiary, which arise when you acquire equity interest in another entity and your holding is above 50%, which usually gives you control. Then in accounting for it, we say we use consolidation method. That is, you need to prepare consolidated financial statements, which is a financial statement of the parent and its subsidiaries that is prepared as that of a single economic entity, which means that this consolidated financial statement should reflect the group's transaction with outsiders. We don't want to see transaction between the group, within the group. We want to see that financial statement as an economic unit. It should show your economic transaction with outsiders. So, and it is on the back of that we are using the cancellation rule to prepare consolidated financial statements. In that, any transactions between the parent and its subsidiaries should be cancelled out, and any uncancelled item can then be consolidated. And that's basically what we are doing. All along, we have been cancelling out the investments in the books of the parent against the equity in the books of the subsidiary. And it's important to know that there can be some confusions, especially around reserves or retained earnings, because reserves and retained earnings are cumulative, right? So, and they are also part of the net asset or the equity of the subsidiary. So when you are doing the cancellation, ensure that the equity you cancel out against the investment in the books of the parent are those equity that relates to that investment, are those equity that were existing at the date of acquisition, are those equity that the parent actually paid for, which is the equity at the date of acquisition. So basically, that's what we are going to cancel out for the most part. And the last question we solved was a situation whereby the parents, after we canceled out, we saw that there was an excess of the investment over and above what the parent acquired. And we said that is goodwill. That is goodwill. So which would therefore be consolidated. Which would therefore be consolidated. We also looked at a scenario where we canceled out and the parent did not buy 100% holding in the subsidiary, in that there was now a balance in the share capital, which now belongs to outsiders, which we call non-controlling interest. We consolidated that as well, but we called it non-controlling interest. We did not consolidate it as share capital because it is not the share capital of the group, because it belongs to outsiders. So we consolidate it and called it non-controlling interest, though it is part of equity because they are part owners of the subsidiary as well. So we put it as part of the equity. And they also share profits or the share part of the retained earnings of the subsidiary. Now, basically, that was all we did. Now, let's quickly proceed with further questions. Now, for this question, we'd see that Pico acquired ordinary shares of ESCO on 30th June when the statement of financial position of each company were as follows. Now, they told us that the NCI is measured at proportionate share of the net assets of the subsidiary. So remember, NCI will arise where the parent is where the parent partly owns the subsidiary. Then the other owners of the subsidiary are known as non-controlling interest. These non-controlling interests are consolidated as part of our equity. The parent has a choice of measuring this non-controlling interest either at proportionate share of the net asset of the subsidiary. By the way we got it, it's determined as just the percentage of the NCI by the net assets of the subsidiary at the date of acquisition. And another way of measuring the NCI is at fair value, which we're also going to see in like the next question. So looking at this statement of financial position of the two entities, since we bought the subsidiary on 30th June and we're given the statement of financial position at 30th June, now the only item that we're therefore going to cancel out is the investment in ESCO against the equity of ESCO. And I'm going to cancel out against this 30,000, this 5,000 inclusive, because this 5,000 is the retained earnings at 30th June, which is the date we acquired the subsidiary. So this is the retained earnings of the subsidiary at that date. So whatever money we are paying, we are also paying for this retained earnings because it is a pre-acquisition retained earnings. But we only bought 20,000 ordinary shares in the subsidiary. Subsidiary has 25,000 shares. That means this 35,000 would cancel out against this. However, there's still a portion that belongs to outsiders who are the non-controlling interest, just like we did in the other question. Firstly, I calculated the parent holding in the subsidiary, which is 20,000 shares over 25,000, because we're told that the parents bought 20,000 shares of ESCO, and ESCO has 25,000 shares. That means the parent bought 80%. Therefore, NCI has 20% in ESCO. So let me do my cancellation. The parents paid 35,000 for 80%. The remaining 20%, I need to add it so that I can be comparing 100 against 100. So I determine my NCI, which is 20% times the net assets of the subsidiary or the equity of the subsidiary. Therefore, before I can determine this, I would always need to do this first. So this is what we call measuring the NCI at proportionate share of the net assets of the subsidiary. Proportionate share, his own proportionate, his share is 20% of the net asset. And the net asset of the subsidiary at the date of acquisition is the share capital of the subsidiary, which is this 25,000, plus the pre-acquisition retained earnings of the subsidiary, which is this 5,000. So together gives 30,000. It is only after I've determined this that I can come and do this, which is 20% of that 30,000. That gives 6,000. If I add these two together, I have 41,000. Cancel it out against this. There's a balance of 11,000. And this 41,000 is higher than this. Therefore, this is a goodwill. This is a goodwill. So this is very similar to the one we did earlier. Okay, Fasheto, I saw your hand. You can ask your question, please.
Okay, sir. Sorry. Well, I was just confused about the retained earnings because, like you wrote here, is pre-acquisition. So I think I was confused because earlier when we were doing retained earnings, I would say that this one because they owned it at the since the company was incorporated, that is um part of the company's part of the parent company's retained earnings or something like that. So I was just confused. That's why I wanted to ask like for clarification.
Okay, I didn't really get your question, but we acquired the subsidiary in June 2017, and we are consolidating on the same dates. So these retained earnings is the retained earnings as at June, which is the date we acquired the subsidiary. So it's part of what we are paying for. It's part of what we met. It's part of the equity at the date of acquisition. It's different from all the questions we have been solving so far, where we acquired the subsidiary since incorporation. In that case, the retained earnings you will see here wasn't there at the date of acquisition. It's not part of what we are paying for. That's why we don't cancel out. We don't usually cancel out that because it's not part of it. It has nothing to do with these investments. They are not related transaction. But in this case, they are related transaction. We bought the subsidiary in June, and that is when we are consolidating. So this retained earnings is there at the date of at the date of acquisition, which is also the same day as consolidation. So it's a pre-acquisition retained earnings. So this
Thank
is
you,
just
sir.
because it's the same day. Okay. Now, after the cancellation that gave rise to goodwill, remember the only reason why this NCI is coming here is just so that this is 100% and this is 100%. Just so that we are comparing 100 against 100. The NCI is not cancelled out, it will be consolidated. So NCI, the value of NCI is 6,000. It's just the value I got here is what I'm bringing here. So in this question, we don't have any post-acquisition retained earnings. The whole of this 5,000 is all the retained earnings because we are consolidating at the date of acquisition. So this retained earnings is entirely pre-acquisition retained earnings. Is entirely the retained earnings at the date of acquisition. So it has been totally cancelled out. So there is no sharing. So we have gotten all we need to get. Then we consolidate. So first, in this question, we don't have PPE, but this that we cancelled out, there was a balance of 11,000 as goodwill, which will be consolidated. The current assets would add that of the parent and the subsidiary together. The equity, this will be the equity of the parent because that of the subsidiary will have been cancelled out. The remaining balance is what we call non-controlling interest, which you have here. And the retained earnings also is that of the parent alone, because that of the subsidiary is a pre-acquisition retained earnings, which has also been cancelled out. Okay, and that's the solution to this question. Okay, the next question. This one says that PICO acquired the ordinary shares of ESCO on 30th June 2017, when the statement of financial position of each company were as follows. The non-controlling interest is measured at full fair value. The market price of the shares of ESCO was 1.30 kobo. So they gave us similar financial position of the two entities, and we are required to prepare consolidated statement of financial position. Now, for this question, you will see that we acquired the subsidiary in June and we are consolidating the same date. So again, when you are doing your equity when you are determining the equity at the date of acquisition, you should know that this retained earnings in this case is totally pre. It's part of what we are going to cancel out fully because the date of acquisition is also the date of consolidation. So the retained earnings is there at the date of acquisition. It's part of what the parent paid for. So similar to the previous question, the only difference here is just that now NCI is measured at full or fair value. So what this is just teaching you is all about NCI, that the parent can either measure NCI at proportionate share of subsidiaries' net asset, or it measures NCI at full or fair value. So let's see how full or fair value will impact our cancellation. So first, we need to cancel out this against this equity. We identify that the parent has 80% holding in ESCO by looking at 20,000 shares they acquired over the total shares of the subsidiary, which is 25,000 shares. That's 80% holding in ESCO. The NCI has 20% holding in ESCO. So, cancellation, the investment of 35,000 for 80% holding, then we add NCI. But in this case, NCI is measured at full fair value. It's measured at full or fair value. So this is different from proportionate share. For full or fair value, we are going to use the subsidiary's market price to determine the value of NCI. Since the NCI has 20% holding in the ordinary shares of the subsidiary, if you calculate 20% multiplied by number of ordinary shares, this 25,000 is actually number of ordinary shares, not this. Is the number of ordinary shares. Number of ordinary shares. If they don't give you this, you need to calculate it yourself. It's just whatever you have here divided by the nominal value will give you the number of ordinary shares. So 20% times 25,000 shares will give us the number of shares held by NCI multiplied by the share price of the subsidiary, which they will always give you. I was given the market price of the shares of ESCO as 1.30 kobo. With that, I can measure my NCI at 6,500. So if I add the two together, I have 41.5. So this 41.5 is now 100%. Then I can compare it with the net asset acquired of the subsidiary, which is ordinary shares of the subsidiary plus the pre-acquisition retained earnings in the subsidiary, which is 30,000. If I compare the two, I have 11.5. So NCI would just the value of NCI as we got above, which is 6,500. Then I can go ahead and consolidate. So goodwill 11.5. I have current assets, which is the addition of PICO and ESCO's current assets. The share capital will be the share capital of the parent because that of the subsidiary has been cancelled out, while the remaining balance is represented as NCI. The retained earnings is that of the parent alone because the subsidiary's retained earnings is totally pre. Then I balance it out. Now, there was a diet a few diets ago. I can ask this for 5 marks. They said the parent company acquired 60% equity interest in its subsidiary for 440 million. I'm told that the market value of the net asset of the subsidiary on acquisition date was 400 million. The parent company estimates that the full 100% interest in the subsidiary company would have cost 640 million required. Calculates goodwill at acquisition dates, where NCI is measured at proportionate share of the net asset of the subsidiary company to fair value of full goodwill method. So this question basically focuses on calculating goodwill, which is gotten from cancellation. First, what's the purchase consideration? How much did the parent pay? So he acquired 60% holding for 440 million. So this is the purchase consideration. Then, you will add NCI. If you are doing proportionate share, that will be 40% times the market value of the net asset of the subsidiary. So we just do 40% times 40 million. Then you then compare that against the net asset of the subsidiary. You see, net asset of the subsidiary is the same thing as the market, as the equity of the subsidiary. So if you are doing proportionate share, you just do 40% times this, the net asset of the subsidiary. So that, because they gave you the market value of net assets, does not mean you're using full or fair value method. No, you are not. Because it's still the net asset of the subsidiary. But the second one, if you are using full or fair value method, in this case, that's where you would apply, you would look for the share price of the subsidiary, but here we're not given. But I'm told that the parent company estimates that the full 100% interest in the subsidiary will have cost 640 million. So if I were to buy the subsidiary 100%, I will have paid 640 million. That's the market value. But since I bought 60% for 440 million, okay, that means the market value of NCI, if I'm using fair value, is the 100% value is 640. The 60% value is 440. That means the value of market value of 40% will be the difference between 640 and 440, which is 200 million if I'm using fair value method. So this is a logical question that requires you to practically understand what we are talking about. So this is what I'm saying. A, it says where NCI is measured at proportionate share. I get how much I paid for the subsidiary, which is the 440 million I paid for the 60%. Then NCI is measured at proportionate share. I just do 40% of the net assets of the subsidiary, which is 400 million. So I do 40% of that. That will give me, I'm measuring NCI at proportionate share. I get 160. So I get 600. Then I will compare that with net asset acquired, which is the 400 million. Then my goodwill is 200 million. But where NCI is measured at full or fair value, in that case, of course, my consideration transferred 440, but NCI at fair value is, I just need to get the market value of NCI. I'm not given share price of the subsidiary, so I can't use that route. But I know that if I'm to buy the subsidiary 100%, I'm going to pay 640 million. But since I bought only 60%, I paid 440. That means the worth of 40% is the difference. And 40% here is NCI. So the fair value of NCI is the difference, and which is what I did here to get my NCI as 200 million. So I compare that with net asset acquired, then I get my goodwill. Okay, that's just speaking a question from past questions. Now, this one states that Pico acquired 75% of the ordinary shares of ESCO on 4th January 2017 when ESCO had retained earnings of 7,500. The market value of the shares of ESCO just before the date of acquisition was 1.60 naira. Pico values NCI at fair value. Goodwill is not impaired. And I was given the statement of financial position as 31st December 2017 for the two companies, for Pico and ESCO. And I'm asked to consolidate. So again, I bought 75% holding in this case on 4th January 2017. And on this date, the retained earnings of the subsidiary is 75. Why they are giving me this is because the statement of financial they gave me is as at another date, at a future date, which is December, which shows that these retained earnings you're saying would include the retained earnings at the date of acquisition. So there is no way I can magically know the retained earnings at the date of acquisition, which is 4 January 2017. And that's why they gave it to you. That out of this 1250, the retained earnings that was there when I acquired the subsidiary is 75. That has to be cancelled out. That needs to be cancelled out. Then whatever excess, which is the remaining 5,000, that is the one you consolidate. That's the one you consolidate. After NCI takes his share, you add his own share to its own value. Then whatever is remaining that you still call retained earnings. So basically, that's just it. That's what this one wants to teach you. So all we are canceling out here is just these investments against this equity. This equity. Just that this one, I can't cancel out the whole of this 12.5. I can only cancel out just 7.5. So I need to show some workings for the cancellation. So I get my consideration transferred, which is what I paid, 34,000, which is 75%. To bring this to 100%, I introduce NCI because NCI is measured at fair value and they give me the share price of the subsidiary. So I can easily get the number of shares the NCI has, which is 25% times the total shares of the subsidiary, which is 25,000 shares from the correction here. That will give you the number of shares acquired by NCI. Then you can then multiply it by the share price of the subsidiary, which was given as 1.60 kobo. When you do the math, it gives you 10,000. Then I add the two together, I come to 44,000. So the net asset that I paid for is the share capital of the subsidiary, which is 25,000. I add it to the retained earnings of the subsidiary at the date of acquisition, which is pre-acquisition retained earnings. I was given that they have to give me of 7.5 because the date of acquisition here is different from the date of consolidation, unlike the previous one where they were the same. And that was why we were conveniently able to use the total retained earnings as pre-acquisition retained earnings. So from there, I got my excess, which we call goodwill, because I paid over and above the net asset. The consolidated retained earnings, I have to work this out. So From the question, the retained earnings of the parent is 35,000. Where is it? Yes, 35,000. That of the subsidiary is 12,500. It's 12,500. So I will need to take out the one we have cancelled out, which is that pre-acquisition retained earnings of 7,500. So that I'm left with the posts. So the parent will take his own share of that post-acquisition retained earnings, which is 75% times 5,000, which gives me 3,750. And I can add it to this parent's retained earnings and brings the total to 38,750. Then NCI. The value of NCI is 10,000. I just picked it from here. Then share of NCI2 will have a share of the post-acquisition retained earnings, which is 25,000 times 5,000. This 5,000. This post-acquisition retained earnings of the subsidiary. So that's 1,250. I add it to this 10,000. Is 11,250. Then I consolidate. Consolidation is just adding parent and subsidiary asset and liability together. Then introducing goodwill from workings 1. Consolidated retained earnings from workings 2. We have already worked those ones out. And NCI from workings 3. Your account will balance. It will definitely balance. Okay, now we're moving forward to the next item. Now, using the same principle, I'm told that PICO acquired 75% of the ordinary shares of ESCO on 4 January 2007, when ESCOs had retained earnings of 7,500. PICO values NCI at proportionate share of subsidiaries' net assets. Goodwill is impaired by 20%. Okay, so the same question, the same. The only difference here is that goodwill is impaired by 20% and NCI is measured at proportionate share. So very straightforward. Let's cancel out. I will cancel out this against equity, but I can't cancel out the entire retained earnings because only 7,500 is retained earnings at the date of acquisition. So I need to show the workings. Just like before, I get the consideration transferred from the question. Now, we are measuring NCI proportionate share, which will be 25% times the net asset of the subsidiary. So I need to work that out below. So the net asset acquired, which is the ordinary share capital of the subsidiary, which is 25,000, plus the retained earnings of the subsidiary at the date of acquisition, which is 7,500. I was given that also. So that gives me 32,500. So since I'm measuring NCI at proportionate share, I will just do 25% times 32,500. Okay. Then that gives me 8,125. I add it to this. It gives me the total amount paid. Then compare it with the net asset acquired. I have a goodwill of 9,625. Now, since I'm told that the goodwill was impaired by 20%, so I will calculate impairment of goodwill, which is 20% of this, and gives me 1,925. I take that away from the pre-calculated goodwill, so it brings my goodwill down to 77. Now, the retained earnings. So I need to sort out this subsidiaries retained earnings. So I set it up like this. From the question, the retained earnings of the parent, 35,000. That of the subsidiary is 12,500. I take away the one I've cancelled out because out of this 12,500, we have cancelled out 7,500. So we are left with 5,000, okay, which will be consolidated. So consolidating it first, so the parent will simply take 75% of that 5,000. And of course, this impairment of goodwill, we are going to expense it. It's going to P&L of the parent. It's going to P&L of the parent. So that's why it's coming here. And that's it. The NCI, value of NCI will also take a share of this 5,000. Then we get the value of NCI. Then we consolidate, just like we have been doing. Then something came to my mind, eh? Talking of goodwill, who owns the goodwill? The parent? Who owns the goodwill? Because I have three parties here.
The parent and the NCI.
The parent and the NCI. Okay, good response. So the reality is this. How do I want to do it? How can I demonstrate it? Okay, you know what? Let's assume this was not there. Let's assume this was not there. I mean, this parent's value. Let me paint it red. Let's assume it's not there. Okay. That means this is just at 34,000. Abi? So if you want to cancel out this 34,000 against the net assets, this 34,000 represents how many percent? 75%. So I will have calculated net asset at 75%. 75% times 32.5. So instead of me to cancel out against this entire 32.5, I will just do what's 75% of 32.5? Anybody?
24,375.
Okay. So instead of this, let's assume this is not there too. So I will have done 34,000 minus this. What would that give you? Can you punch your calculator?
So out of the retained earning,
Which return earnings again? Is it not included in this 32.5?
okay.
9625.
You got 9,625. Okay. Now, I just wanted to show you that the goodwill belongs to the parents. So the fact that NCI is included here does not automatically mean that he has a share in the goodwill. It belongs to the parents. That is what I just wanted to show you. So this 9,625 belongs to the parents, and that is why when it was impaired, it was the parent that suffered it. It was the parent's profits that suffered it entirely. NCI will not take a share. However, you see, if NCI is measured at fair value, if NCI is measured at fair value, NCI will have a share in the goodwill as well. You will have a share in the good. They have asked it before that you should calculate the NCI share in goodwill. You see, when NCI is measured at proportionate share, it's like in and out. What is up here, which is 25% of this, it is the same thing as 20. I mean, it's in and out for the consideration paid and net asset. As far as NCI is concerned, is in and out, the same figure up and the same figure down. 8125 because it's proportionate share. It's in and out. So that's why when I demonstrated it, that I closed out this, I was still getting the same 9625. But if I should go up, where I measured NCI at fair value, you see this 11.5 goodwill that we got, NCI has a portion. Can show you in two ways. Now, the first way, just like I did, let me assume this is not there. And this guy, 34,000 for how many percent? 75%. So help me do 75% times 32.5. Which is this? What was that?
24,375.
24
375.
375. Okay. So what's 34,000 minus this?
Nine six two five.
9625. So that's the goodwill of the parents. You see, the difference, the excess belongs to the subsidiary. Sorry, belongs to NCI. Out of this 11.5, that of the parent is this. If you do it like that. Alternatively, we want to calculate just that of the subsidiary alone. Sorry, the NCI alone. So since the fair value of the NCI is 10,000, so how much is the value of the net asset of the subsidiary? Is 25% times 32.5. So how much is that?
8,125.
8125.
8,125.
So you are
Okay.
you muted? Okay.
So that's how much?
8,125.
8,125. So what's 8,125 minus this is how much? Abi? Is that it?
Yes, sir.
Okay, so this is the goodwill. Out of this 11.5, the goodwill of the NCI is this. So why I'm mentioning this is just for you to understand that NCI too might have a share of the goodwill if it's measured at fair value. If it's measured at fair value, you will have a share. If it's measured at proportionate share, it's just in and out, it doesn't have any share. Okay, let's go back to what we're doing. So for this one, we had done our cancellation, we have consolidated, and we can easily prepare our consolidated counts, just like we have always done. Now, the next one.
So, sir.
They said Pico acquires 75%. Yeah, I'm with you. Please go
Yes,
ahead.
sir. I just want, so for us to know the either NCI has share, is just to know the difference, either at proportional or at fair value.
Yes.
Okay. Thank you, sir.
Yeah, you're welcome. But the reality is that it does not really matter. Really, that is share. We don't use it for anything. Why I'm mentioning it is
Okay.
in case ICAN just wants to stress you a little bit. Ordinarily, it is of no relevance in our consolidation, really, because we consolidate everything. So that's why I just need to mention it. So, Pico acquired 75% of the ordinary shares of ESCO on 4th January 2017 when ESCO had retained earnings of 75. The market price of the shares of ESCO just before the date of acquisition was 160 kobo. Pico values NC at fair value. Goodwill is impaired by 20%. I was giving them a financial position, prepare consolidation. Okay, so again, almost the same thing. The only difference here is that NCI is measured at fair value. That's the only difference. Every other thing is the same thing as the previous one. So consideration transferred. Now NCI is at fair value, which is 25% times the number of shares of the subsidiary times share price, which is 10,000. So I add the two together. The net asset of the subsidiary, ordinary shares 25,000, retained earnings of the subsidiary, which is the pre-acquisition retained earnings 75. So the difference 11,500. Goodwill at 20% gives me 2,300. So in this case, since NCI is measured at fair value, like I've shown you, you will have a share of that goodwill. And you just need to have an understanding of that. Nobody is asking you to calculate the share of the goodwill. It's not relevant. Okay. The only thing that is relevant is now that since the goodwill is now impaired, it's not only the parent that will suffer the impairments, it's the two of them. The NCI too will suffer that loss of goodwill, suffer it. So, and how does it do that? Is in retained earnings. So first, we get retained earnings of the parent and that of the subsidiary. We take away the pre, because that has been cancelled out, left with these posts. Now, ordinarily, they are supposed to share this 5,000, parent subsidiary, parent NCI. But I would remove that impairment first, because now it's the parent and the NCI that will suffer this impairment. That's why I'm taking it away from what they want to share, so that two of them can suffer that loss proportionately based on their holding. You see that in the previous one, I didn't take that impairment from the subsidiaries' earnings. I took it away from the parents alone. So it was the parents alone that was suffering it. So in order to make the two of them suffer the effect of these impairments, I take it away from what they are sharing. So they're only left with 2.7, which is what they will share. So the parent got his own 75%. NCI will get his own 25%. Okay. So that's what you will add to the value of NCI, which is 10,000, which I picked from here. It's 10,000 here. 10,000, yeah. So, and that is all. You can then consolidate by adding all these figures together, that of the parent and NCI, then taking into consideration the goodwill as computed above, which is the balance that is not impaired, the consolidated retained earnings as computed above, which is 37,025, this one, and the value of NCI, which is this, which is part of equity. Then other figures, I just add that of the parent and the subsidiary together. And that is all for that. The next one. It says Pico acquired 75% of the ordinary shares of ESCO on 4th January 2017, when ESCO had retained earnings of 75. Market value of ESCO shares before date of acquisition is 130 kobo. NCI is valued at fair value. goodwill is not impaired in this case. So they give us the financial position of the two companies. So that's all. So we just need to cancel out this against equity. So consideration transfer 24,000. I cancel it out against NCI, which is 25% times the ordinary shares, number of ordinary shares, which is 25,000 ordinary shares, multiplied by the share price of the subsidiary, which is 1 naira 30 kobo. 1 naira 30 kobo. Then I have 8125. So I add it together. I canceled out against the net asset of the subsidiary, which is 25,000 plus the pre-acquisition retained earnings. Okay. Now, then something strange happened. In this case, we are having a scenario where the net asset acquired is now higher. So we paid less. We paid less. So in this case, this 375, we call it gain on bargain purchase. This is rare. This is very rare. We don't expect this to happen. We don't expect to have a gain on bargain purchase because there's no reason why somebody will collect less than its net assets. Because net asset is the very floor value anybody will want to collect. That's the floor. That's the bare minimum. So why would the subsidiary accept a lower amount? Why would they accept that? Okay. So whenever this happens, IFRS 10 requires the parent to do some reassessment. The parent needs to do some checks. He needs to check that has he actually measured the net asset of the subsidiary very well? Are they all at fair value? You will recheck those measurements. We would also check the basis of how he has measured NCI, that there are no mistakes. And you also check the amount he paid, that hope he didn't mistakenly choose the wrong amount. He needs to check all those components and reassess them to be sure. So if he sees that there's a mistake, then he can update this computation. That's the requirement of the standard. But in this case, we are not going to be doing that. We have a situation of a gain on bargain purchase. It's a gain to the parent, which is going to go to his P&L straight on. So consolidated retained earnings. So as per the correction, these are the retained earnings of the parent and the subsidiary. I take away the pre that has been cancelled out. I'm left with the post-acquisition retained earnings, which will be shared between the parent and NCI. This is gain on bargain purchase. I add it to that of the parent. This is the share of the retained earnings of the subsidiary. So we are left with this. NCI, value of NCI 8125. Remember, I got it from here. Then it gets his own share also of the post-acquisition retained earnings. So I have a total of this. And I can consolidate my figures together. Consolidate my figures. In this case, I don't have goodwill and all of that. So I can easily pick my consolidated retained earnings and my NCI for my workings. Every other one, I'm just adding the line items of the parent and the subsidiary together. So it's just cancellation. Now, another question. It says PICO acquired 75% of the ordinary shares of ESCO on 4 January 2017 when ESCO had a retained earnings of 7,500. On that date, PICO made a cash payment of 34,000 and a further payment of 10,000 on 31st December 2018 if ESCO post-acquisition profit have exceeded an agreed figure by that date. NCI is measured at proportionate share of subsidiaries' net assets. So we're required to, so they give us statement of financial position of the two companies. And we are required to prepare consolidated statement of financial position of PICO at 31st December 2017. The parent company's cost of capital is 10%. Now, what is different in this question is the fact that the parents will also make additional payments in 2018 if the parents' post-acquisition profits have exceeded an agreed figure. So we usually call this contingent consideration. Contingent consideration. So is going to make a payment if certain conditions happen. In this case, if the subsidiary is able to achieve a particular profit or exceed a particular profit figure, he said he will give him additional 10,000. That's contingent consideration. Is almost the same thing as deferred, just that for deferred consideration, that one there's no condition attached. It's just I will give you extra money. No condition is attached. Now, ordinarily, when you have contingent consideration, IAS 37 says you should not recognize it in the books because it's not probable. It's not a probable obligation. It's just possible. So, and the measurement is very uncertain. But in this case, IFRS 10 allows the parent to factor it in and recognize it in the books as a liability. He can recognize it in his books as a liability. This 10,000. But since this 10,000 is a future payment, we would not recognize the 10,000 that today because we are paying this in 2018 and we are doing our consolidation in 2017. So we are not going to recognize 10,000 because the value is not 10,000 today. We need to discount it to present value. We'll get the present value of that 10,000. And that's why they gave us this cost of capital to use as the discount rate. And that is what we're going to do. So for my cancellation, okay, this 34,000 in the books, they have already recognized this 34,000, which is the one he paid in cash, plus the contingent, which is 10,000 times 1 plus 1 raised to power minus 2. This minus 2 is the fact that I'm paying in 2018. And I promised him in 2017 on the date of acquisition. If you count from January 2017 to December 2018, you see that there's a 2 years gap, 17, 18. So I need to discount back to these dates, this present value, because I am doing this cancellation on that date. I want to get this value on that date. So I discount this contingent consideration to present value. If you punch your calculator, by doing 1.1 raised to power minus 2, you multiply it by 10,000, it gives you this. And don't forget, this 1.1 is like 1 plus R, and the R is 10%. So 1 plus 0.1, that's 1.1 raised to power minus 2. So when I get this, then I add my non-controlling interests because I only acquire 75%. And in this case, NCI is measured at proportionate share. So I'll just do his own share times the net asset of the subsidiary. So before I get this 32.5, I need to do my net asset acquired, which is the ordinary share capital of the subsidiary plus the retained earnings of the subsidiary at the date of acquisition which is the pre-acquisition retained earnings, which is what they gave me here, this 75. So I get 32,500. So I do 25% times 32,500, and that gives me 8125. So when I add this plus this plus this, I get 5389. I compare it with the net asset acquired. I have a goodwill of 17,889. At the end of the year, the contingent consideration would increase because since we got its present value, so at the end of each year, we'll be unwinding the discounts because of time value of money. And since this was done at the date of acquisition, so at the end of the year, the value at acquisition is this 8264, which is this value we got here. You would add the unwinding of discounts, which is like finance costs, interest. And that is determined as the interest rate of 10% as given in the question times the opening value, which is this 8264. So that gives us 826. So this one, we are going to take it to P&L of the parent as a finance cost. So by the time you add the two together, so this contingent consideration, we are going to take it to our current liability as a liability, which should be consolidated. Then the retained earnings of the parents from the question is 35,000. From the subsidiary is 12,500. I take out the pre, so I'm left with the posts that will be shared by the parent and NCI. Then remember to take away the interests, this unwinding of discounts, the interest. Then the parent take his own share. So the addition of this, this, and this gives us this consolidated retained earnings. And NCI, the value of NCI is 8125. This 8125 that we got here, up here. And he also take his own share of the subsidiaries retained earnings. Then he has his value. Then we consolidate by adding the parent and the subsidiaries figures together, then picking goodwill, consolidated retained earnings, and NCI from our workings. And not forgetting to add the contingent consideration as part of your liabilities, this 9090 from our workings as well, in workings 2 here. Okay. Yeah, Fashion, I can see your hand. Please go ahead.
So I wanted to ask that, like, after this calculation, let's say the company in 2018 does not now meet that target. How would this be reversed, and how will it be reversed this time?
Just debit the P&L. You just cancel out the contingent consideration at that date. Just debit the contingent consideration. You'll probably be crediting either your P&L or thereabout, because ordinarily now, the contingent consideration has impacted to a large extent the value of our goodwill. Okay. So, and also it is showing here as a liability. So most likely, if you are going to cancel it out, if it doesn't meet up, is for you to cancel out this liability. And at that date, this liability will have become 10,000. So it's for you to debit this liability. And most likely, you might want to even credit your, instead of P&L, you might even credit your goodwill. because that's where the second leg is showing. That's where the second leg of this amount is showing. But, what you put in goodwill was the historical costs. So it might be this one that you're going to credit goodwill, then any excess, you might take it to P&L direct. Okay. Yeah, David.
Thank you, sir. Please, can you explain why we're doing finance cost on this contingent consideration? I don't understand.
So anytime we discount to present value, anytime we do discounting to present value, it's only accounting for time value of money. The future value is 10,000, we discounted by 2 years. At the end of each year, there's something we call unwinding of discount. You will unwind that discount. Since we discounted by 10% for 2 years, so you'll be unwinding it so that in the next 2 years, we want this value to have become 10,000. So we do that through interest. It's an interest accounting for time value of money. And that's what is accounting for this. You see, if you do another 10% next year, if you do 10% of 9090, which is 909, if you add it, it becomes 10,000 or 99999, which is like 10,000, really. So that's why we always do that. Even when I teach you provisions and we do discounting, at the end of each subsequent year, you unwind. We always do that at any point we do present value in financial reporting. You need to be unwinding that discount at the end of every year. So that when you get to that time in the future, that liability becomes that future amount that you discounted some years back. So that's why we did that. And we usually expense it. In this case, it became an expense in the books of the parent, like that. The good thing is this. The core principle hasn't changed. It's just, if I were you, I would just concentrate on each new things that they are bringing. The main thing has not changed. The very background hasn't changed. It's just that I'm just adding one more principle, just to teach you the very simple things. Then I will now take a question that will put everything together, just for me to be sure that you have actually learned everything. So that's basically pretty what we are doing. So this one is basically the new thing here is just that contingent consideration, right? Which I can see is what you guys are actually focusing on also. Now, the next one, almost the same question. Now is also adding additional thing for you to learn. So I acquire 75% of the ordinary shares of ESCO by issuing 5 of its own €1 shares for every 3 shares in ESCO. On 4 January 2007, one ESCO had retained earnings of 75. The market value of the parent company's share is 5 naira. NCI is measured at proportionate share of subsidiaries and assets. Statement of financial position as at this date is this required? Prepare consolidated statement of financial position of PICO at 34 December 2017. So for this one, the only new thing here is the fact that the way the parent is paying by giving shares to the subsidiary. So he acquires 25% of the shares of ESCO by issuing 5 shares for every 3 shares. By issuing 5 shares for every 3 shares in ESCO. That's the only new thing here. So you see that we don't have any investments recorded here yet because he did not pay money. He gave shares. So we need to do that calculations ourselves. So the consideration he gave was through share exchange. And he's giving 5 shares for every 3 he has acquired in ESCO. And he acquires 75% of the shares of ESCO. And total shares in ESCO is 25 ordinary shares. So 5/3 times the number of shares he has acquired in ESCO, which is 75% of 25,000. If we do the mathematics, it's giving out 31,250 shares to ESCO. So to get the value of these shares, I multiply it by the share price of the parents. So they gave us the share price of the parents, since it's the one giving out shares. So the consideration transferred is this, 156,250. Since they have not recorded this investment in the parent hasn't recorded it at all, and that's why I'm passing this double entry. So it needs to debit investment in subsidiary of that amount. Then since is giving out his shares, I will need to credit share capital. But what goes to share capital account is always at nominal value. So this is the number of shares is giving out, which I computed up here, multiplied by 1 error, which is the nominal value of the shares of the parents. This is 1 error. This is 1 error here. So I get 31,250 times 1 error. So any excess goes to share premium account, which is this minus what I'm going to share capital. So I get 125,000. And that's the double entry for this consideration. Now that I've gotten my consideration, I can then determine the cancellation. So I paid 156,250 through share exchange. NCI is measured at proportionate share of subsidiaries net asset. So NCI has 5% holding. I multiply it by the net assets of the subsidiary. So before I got this, I probably will have calculated this, which is the share capital of the subsidiary. I add the retained earnings of the subsidiary at the date of acquisition, which is they give me in the question. So I have 32,500. So if I compare it with this, I have a goodwill of this amount. Then my retained earnings, this is that of the parent, that of the subsidiary. I take away pre. So I have a post of this. The parent will take his own share. So I have the balance here of 38,750. NCI also, I have the value of NCI. Parent take his own, the NCI take his own share of the post, retained earnings of ESCO. Then I add the two together, get my value. That's it. And I consolidate. So I'm adding the line items of the parent and the subsidiaries together. Then I pick goodwill, consolidated retained earnings, and NCI for my workings. Additionally, I credited share capital with 31,250. That's why I'm adding 31,250 here. And share premium was also introduced at 125,000. Yeah, this amount here. So I must not forget to include them, otherwise my account will not balance. My account will not balance. Yeah. Any questions? Okay. Yeah, Shay.
Yeah, please, just to quickly grab it again, can you help with a recap of how you treated the shares again, please?
Oh, okay.
To the start. Yes, thank you.
Yeah. So for the share exchange, I'm giving the subsidiary 5 shares for every 3 shares are acquired in the subsidiary. So that's where I came about this 5/3. 5 shares for every 3. So of shares acquired. So the shares are acquired in the subsidiary is 75% of the number of shares of the subsidiary. So when I do the calculations of that, it gives me 31,250. Then I get the value by multiplying the number of shares I'm giving the subsidiary by my share price. I was given my share price, that's the parent share price in the question. That's 5 naira. So this is the value. So this value hasn't been recorded in the books, so I need to record it by debiting investments in shares. I would debit in investment in subsidiary. Then since I'm issuing shares, I credit my share capital. Share capital is always credited at nominal value, which is 1 naira. So that's what goes to share capital is 31,250. Any excess goes to share premium. So if you do this minus this, it gives you what goes to share premium. So every other thing remains the same. Every other thing remains. That's the only new thing here. And I must remember to therefore add the 31,250 to my share capital because I just issued it out. And the excess that went to share premium. That's that. That's the only new thing here.
Thank you. Thanks, sir.
You're welcome. Now, let's put everything together that we have learned so far. So here, I was given a statement of financial position of PICO and ESCO as at 31st December 2017, parent and subsidiary. So I was told that the parent acquired its investment in ESCO on 4th January 2017, when the retained earnings of ESCO stood at 3,000. So this is the pre-acquisition retained earnings that will be cancelled out. The agreed consideration was 15,000 and a further 5,000 on December 31st, 2018. So this will be a deferred consideration as the value is not dependent on any condition. This money is not dependent on any condition. So PICO's cost of capital is 8%. So they are giving me this so that I can use it to discount this to present value. Also, that ESCO has an internally generated developed brand, which was valued at 2.5 at the date of acquisition. So ESCO has a brand at 2.5, and there have been no changes in the share capital or evaluation surplus since the date of acquisition. So his share capital and evaluation surplus hasn't changed since the date of acquisition. So that means the revaluation surplus that the subsidiary has in his books is pre. It's totally pre. Because it hasn't changed. That's what they are telling us. They didn't mention this because this has changed. At the date of acquisition, it was 3,000. Now it has grown to 14. It has grown by 11. So that 11 is posts. So they have, yeah. So at the end of the year, ESCO had invoiced PICO for some goods at 1,000 and had sent in payment in full, but this has not been received by ESCO. So that means there's a cash in transit. Okay, so which is why I can see here that the parent is saying that he owes the subsidiary 4,000, but the subsidiary is saying that it's 5,000 you owe me. Okay, and that's because the parent has paid 1,000 that this guy hasn't received. So of course we are going to cancel out, but that 1,000 will be consolidated because it's outside of the good. It's outside of the goods. Sorry, it's outside of the group, and it's a goods in transit at the rate of 1,000 naira. So they also measured NCI at full fair value at the date of acquisition at 9,000. So they gave us the value of NCI. So it's straightforward. It's just for us to carefully adjust each items. So again, all we are doing is cancellation. So I'm canceling out this, and I'm canceling out this against this. They are not the same. Whatever is remaining is goods in transit. So how do I do my cancellation? Firstly, I need to get the investment in subsidiary fully. The cash paid of 15,000 was given, but in addition to this 15,000, he promised to pay additional 5,000 in 2018, meaning in 2 years' time. He made the promise from the date of acquisition. So I got my percentage acquired, the parent holding in ESCO. He bought 10,000 shares and the parent has 12,500 shares. That is 80% holding. How do I know? These 10,000 shares that he acquired, and the parent has, the subsidiary has 12,500 shares, which is 12,500 divided by 1 naira. That's 12,500 shares. So that's 80%. That means NCI will have 20%. So the consideration transferred, cash of 15,000, this was recorded, but the deferred consideration wasn't. So since this 5,000 is a future payment, I need to discount it to present value. So I do 5,000 times 1.08 raised to power minus 2. And this is where I got the 08 form. They gave me the cost of capital. The 2, I made the promise of payment at the date of acquisition, which is 1st of January 2017. I said I'm going to pay in 2018. Within those periods is 2 years. That's 2 years, 17, 18. That's where I got this 2 from. If I do the math on my calculator, the present value is 4,286. If I add it to this 15,000, I get 19,286. Aside that, they mention an internally developed brand. Of course, I taught you in IS 38 last week that internally generated intangible assets are not recognized in the books, which is why you won't find it in the books of the subsidiary. You will see that it wasn't in the books of the subsidiary at all. But on consolidation, it is recorded because now it has a value. And it has been valued at 2.5. So we need to include it. And to include it, as we are debiting intangible assets with 2.5, you need to credit a reserve. We call it fair value surplus. That is where the corresponding credit will go. Is a fair value surplus. Becomes part of the reserve of the subsidiary. And therefore, this reserve is why it's pre is because this brand was valued at the date of acquisition. Okay, so this reserve becomes pre. It will be cancelled out on consolidation. So let's do our cancellation. The consideration transferred computed is this, which is this 19,286. The NCI value was given to us straight as 9,000. It was given to us as 9,000. So the total consideration is this. Cancel it out against the net asset of the subsidiary by looking at the share capital of the subsidiary, which is 12.5, plus the retained earnings of the subsidiary, which is the pre-retained earnings, as given here, 3,000. Then the pre-acquisition fair value surplus, which we got from here, the internally generated brand name. Then the evaluation surplus, which is in the books of the subsidiary, this 2.5 here. Why this is still pre is because they said that it didn't change since the date of acquisition. So it has always been 2.5 since we acquired the subsidiary. So we cancel all that out. So if you add all this together, we get 2,500. Take it away from this, we get 7,786 as goodwill. Then my retained earnings, from the question, the retained earnings of the parent is 13,000. That of the subsidiary is 14,000. I take out the pre-acquisition retained earnings, which is just the 3,000. Then this is the posts. Now, my finance costs that is coming is because of this deferred consideration here. Just like I did for contingent consideration, anytime I do present value, I need to unwind the discount. So at the end of the year, so I will just do 8% times the opening value. That's what gave me this 343, which I will add to this to give me 4,629. And that's where this 343 is coming from as an expense in the parent's profit. Then the parent will get a share of ESCO's retained earnings, which is 80% of this 11,000. So 8,008. So if I accumulate all of these together, I have a consolidated retained earnings of this. So the value of NCI is the value as given, 9,000. It gets a share of the subsidiaries retained earnings also, 20% of 11,000, which is 2,002. So 11,200. And deferred consideration as explained. So what is left is just to consolidate. So I add PP of the parent and the subsidiary together. I picked my goodwill for my workings. I picked my intangible asset for my workings, my inventory, my cash in transit, which is the balance, the 1,000 that we won't cancel out. Then the receivables, I consolidate all of that. The share capital is that of the parent alone. The retained earnings for my workings. This valuation surplus is that of the parent. That of the subsidiary has been cancelled out. NCI for my workings. Then I also remember to put my deferred consideration for my workings. So, and that is all of that. So this brings together a lot of things that we have mentioned so far. So it's already 10:30. I'm going to stop here for today. So next week, within 1 hour, in our first period, I will take out what is left. Is nothing new. It just takes time to explain. So we just continue our cancellation. Just that we are not going to look at further items, like when there is intra-group sales of inventory and intra-group sales of assets. We'll look at those areas and how we cancel them out. It's still the same thing. So I'm going to be doing that we're going to be doing that next week, Saturday, and next week, Sunday, I mean. And I hope that we're able to finish up this topic so that in March, next week, Saturday, Sunday is mostly March, right? It's March already. So yeah, next week Sunday is March. So I hope we finish this in March so that for the remaining 1, 2, 3, 4, for the remaining 4 weeks in March, we are going to basically focus on things like statement of cash flows, financial instruments, and leases. And I hope to take out sustainability reporting also. So you can take those ones out, then what is left for us is just very little, very little. While I'll see you guys for SBR on Wednesday. Thank you very much. Make sure you revise. No assignment today. All you need to do is to revise this. I don't want you wasting too much time on group accounts. It's an optional part of our exams, but for the professional guys, you need to understand these basics very well so that when I start teaching you the advanced parts, it will be very fast and seamless so that we can spend more time in solving advanced questions. Again, thank you. Do have a wonderful evening.
Good evening.
Sorry, please help us drop a note, please.
Please, also the recording.
All right, no problem. The recording will be dropped
Thank
tomorrow,
you.
or the notes
Thank
today.
you.
All right.
Thank you.
Thank you,
Bye-bye.
sir.
Bye.
Good night.